All right, this is Zubair on behalf of Electronics, and in this video, we're going to be talking about bond yields. Okay, now when you look at a bond, okay, the first question you might ask yourself is how much am I getting out of this bond? Okay, what is the return on investment? How much am I making from capital gains if I sell this bond? How much am I making from interest? Okay, that's the interest that you receive from bonds. All right, so when it comes to bond yield, and let me write this down over here. Your bond yield is based on three factors. Okay. So number one has to do with liquidity. Okay. Number two has to do with after tax return. And number three has to do with risk. All right. So when we talk about liquidity, okay, we're talking about volume. Okay. The bigger the bond issuer, let's say this is a corporation, a big corporation. Okay, they're more liquid, the bonds, right? Because they're able to trade, they're able to sell these bonds in high volume. Okay, as a result of which, okay, you do have a lot of buyers. Okay, you do have a lot of people who are interested in these bonds. Okay, they're more liquid. Okay, the transaction is more liquid. All right. Now, apart from that, you also have your after-tax return. All right. Now, the after-tax return is the return, okay, from the income, okay, relevant to your interest and capital gains after you pay taxes on both interest and capital gains. Okay, so if a bond issuer issues a bond, okay, let's say you've got an investor who makes an investment in that bond, okay, buys the bond will pay periodic interest payments. Okay, and when the bond investor sells that bond, okay, he or she will receive capital gain. Now, there is tax on both of them. Okay, there is tax on the interest payments as well as the capital gain. And this is what you subtract from your total income, okay, to get your after tax return. All right, now apart from that, you also have the risk factor. Okay, so the risk factor has to do with things like market volatility. Okay, what is volatility? This is fluctuations in share prices, okay, because of current events, for example. Okay, the oil prices might be going up and down. The gold prices might be going up and down. Prices for rhodium might be going up and down. Prices for platinum may be going up and down. Okay, now if the prices fluctuate too much, okay, it is highly volatile. And in a highly volatile market, okay, all the investments you make, especially in corporate bonds, are very risky. Okay, compared to let's say treasuries and government bonds. All right. Now, based on that risk, okay, you also have a higher yield. Okay, even though corporate bonds are riskier to invest in, especially when the market is volatile, okay, the return is high as well. Okay, sort of like gambling. Okay, the stakes may be high, but the return is high. All right, sort of like sports betting. Okay, the stakes may be high, but the return is high. Okay, likewise, okay, when it comes to treasuries, okay, the return may be low, okay, but the risk factor is low as well. Okay, not to mention treasuries or government bonds are less liquid as well. Okay, because as we talked about volume, okay, these are not sold in high volume compared to some of the corporate bonds out there. Okay, there may not be a lot of buyers or investors for the government bonds because they do not pay as much as the corporate bonds out there. All right, so that has to do with the risk factor and liquidity. On behalf of B Electronics, this is Obey. Have yourself a great day.